Post-mortem. Here's the dictionary definition. An examination of a dead body to determine the cause of death. In the context of investing, it's revisiting all your transactions. You'll see what you've done well and what you've done not so well. I highly recommend occasionally going through your broker's history log on each of your positions. We're going to take a look at my Meta postmortem. I've been selling options on Meta since September 2021. That's about when I first got started selling options. I'm going to analyze each Meta transaction I've done since then, 47 in my Schwab history log. We'll look at a pretty chart of them, and then I'll describe and evaluate each one. My goal with options is to buy great stocks at slightly lower prices by selling aggressive cash secured puts, and then slowly and carefully lower the cost basis by selling covered calls until they're overvalued or a better opportunity comes along. I've found selling options to be extremely fun and beneficial. They keep me interested in all my holdings, so I stay up to date on their news, and they've cushioned the losses from the recent bear market. Let's see how I've done on Meta. Here's a tease. I've had to roll my calls way out in time. This would be bad if you view options as a get-rich-quick scheme, are focused on the short term, or want steady income with your options. But that's not how I look at options. I'm focused on lowering the cost basis and increasing long-term results. Behind me, you see what Meta stock has done over this period. It's been very volatile, going way down and then recently coming back strong. So here's this pretty chart. Maybe it's not so pretty. There's a lot going on. The yellow line is my strikes, my call strikes that I've set. I started out nice and high, but then as Meta fell, I had to lower my strikes. And when the yellow line goes below the red line, that means my strike prices have gone below the cost basis. That's usually not a good thing. So the red line is the cost basis. You can see it steadily goes down. Now this red line is a little too optimistic because it doesn't consider the value of the current open options. It assumes they're going to expire worthless. That is until the very end here, where I add back in the current value of the option. And then the blue line is price of Meta through this time period, the underlying stock. Now we'll talk about the current situation I'm in. My cost basis, if I wait it out, will go down to about 243. But if I wanted to close out today, my cost basis would be 296 because my current call option has gone way up in value, which is bad for me if I wanted to close now, which I don't. Let's go through the transaction log now. Let's go through these 47 transactions. So on March 15th, 2021, I bought 150 shares of Facebook at an average cost of $272. Meta closed at $273 that day. Wasn't doing options yet, so I didn't do any options. Then in September, I sold 2 puts with a strike of 325. Meta was currently selling at 330, about 340. And then a week later, October 5th, I closed that out for a $350 loss. That was probably one of my first option transactions. So why would I have done that? I guess I got scared and didn't Didn't want 200 more shares of Facebook, so I closed it out. But let's not read too much into that one, because I was just getting started with options. Then, a week later, October 12th, 2021, I bought 50 more shares because I wanted to be able to sell 2 calls. So now I've got 200 shares. And I bought those at $3.23, so my average cost is now up to $2.86. Then on that same day, 2012, I sold 2 calls with a strike of $3.50. Meta was selling at $3.24, and I got $2.43, so my cost basis went down a little bit to $2.83, assuming that option expires worthless. 3 days later, I decided to sell 3 puts. That's kind of aggressive. I sold those puts at 300 strike, and Meta was currently 324. Then 6 days later, I closed it out for a nice gain. I made about $700 profit. In hindsight, that was kind of a risky move. That was a big percentage of my portfolio, and I don't want to go that big usually because I risk blowing up my account. But it worked out. I lowered my cost basis by 3.5, so now my cost basis is down to 280. So typically I like to sell options between 30 and 60 DTE, days to expiration, but this one, way back when I was starting options, I only set the DTE at 2 weeks, from October 15th to October 29th, so that was unusual. On October 26th, 5 days later, I sold another put at $2.95 because Facebook had gone down a little, so I was buy the dip by selling a put. And I got $4.80 for those, so I got my cost basis down to $2.75. So on October 29th, 3 days later, the call expired worthless because Facebook is not doing much there. It's $3.23. Doesn't look like I opened a new call right away, so let's see when I open my next call. 2 days later, I closed that put for $185. How much did I get for those 2 puts? I got $479 for those. Well, no, I actually times 2, so I got almost 1,000 and closed it out for 200. So I made almost $800 on that. So that's another good put. But closing it out raised my cost basis because I was assuming it was going to expire worthless, but I closed it out early. So then that same day, November 1st, I sold another covered call. I got $3.72. The 370 strike. Meta was currently going for 330. Cost basis went down to 272. And this time I did it for about 45 days to expiration. And I used the monthly expiration. I like to do monthlies instead of weeklies because they're a little more liquid usually. So the spread's a little narrower. And monthlies happen on the 3rd Friday of each month. So the next transaction was I closed the call. A month later, about 2 weeks before its expiration because Meta had gone down to 310 and the call was only worth a quarter. So I closed it out early. I probably would have rolled here if I'd had more options experience, but I was waiting for Meta to bounce before trying to sell the call again. That was my thinking back then. And that's somewhat reasonable. I've heard you want to try to sell your calls as the stock's going up, but I'm not sure that's really makes a big difference. Then 4 days later, I did sell the call, and Meta did go up a little bit, so that worked out. I sold a 360 call when Meta was at 318, and I got $3 for it, so my cost basis is down to $269, assuming this call expires worthless. And once again, about a 45 DTE monthly. Then a month later, in January 2022, I closed that call for 40 cents and opened a new call out in February for 365, and I got a 320 credit, this minus this. So now my cost basis is down to 266. Then 16 days later, I closed that call for 40 cents. And I didn't open a new one yet because Meta had taken a downturn and I was waiting for the bounce. I don't know if it happened though, probably not. And a day later, I did sell that call right before a big earnings miss. And I set that DTE at about 50 and I got almost $3. So my cost basis is down to 264. Then about a week later, I closed that call. Facebook was beginning to crash. I was waiting for an update to sell another call rather than rolling. To reiterate, I don't do this much anymore. I usually just roll. So that cost me 28 cents. Cost basis just went up a tiny bit because I was assuming it was going to expire worthless. So now I'm a week later, February 10th, 2022, and I sold a call for $215. Got my cost basis down to $262, but I had to sell it at a much lower strike because Facebook was crashing hard down to $228. So over about 37 days later, March 18th, I closed that call for a penny. That was on its expiration day. And then I opened a new call for $250, made about $2.90. So my cost basis is down to $259 now. But Facebook was falling way faster than I could collect premium. So the price of Facebook is significantly below my cost basis. But my calls are also now just a little bit below my cost basis. So then, 2 months later, I let that call expire worthless. I waited a while before selling more calls because I was thinking Facebook would bounce, but no, didn't happen. So I did nothing for a month and a half, and then in July, early July, I sold a 220 call. Facebook had bled all the way down to 171. So my strike price was 220, starting to get well below my cost basis, which was down to 257 and a half now. And they changed from Facebook to Meta at this point. So a month later, I closed that call for 6 cents. And so I rolled to a 260 call. So Facebook bounced up $7.50 from $6.50. But I only got $1.70 for it, so my cost basis is at $2.56. But I got my strike price actually above my cost basis. But I had to roll all the way out to December, so that's a 4-month DTE. And that was my first time rolling out that far. So a month later, Facebook had gone down to 162. So I closed out that long call for 50 cents. So this is what's called rolling down and in. I rolled down to 185 or 85 lower, but because I took off so much from the strike, I was able to roll it into October, or 2 months sooner. So now I'm back to like a month and a half DTE. And I got almost a $2 credit there, so cost basis is down to 254. Then about 2 weeks later, Meta continued to go down. So rolled it out a month to November, and rolled the strike down 10 to 175. Got a $2.50 credit. Cost basis is down to 251 and a half here. Then a month later, October 27th, 2022, Meta had gotten so low I decided to sell a put. Meta was all the way down to 98. They were overspending on the metaverse and everyone was worried about their declining revenues and earnings. I wish I would have sold more puts here because this was close to the bottom, but I didn't have the guts. But I did at least sell this one put and got almost $4 for it. Then 6 days later, this was Meta's absolute bottom, I closed out that put for $7.65 and opened a new one at 90. I rolled out to a 2-month DTE in January, but I got a 60-cent credit, 70-cent credit. Either I didn't want to get assigned or I thought I could get assigned lower. Can't quite remember. So my cost basis here is down to 249-ish. So then 7 days later, Meta's starting to rebound a little. I closed out that put I just rolled. Ended up making a gain of $200 on that put. And my cost basis is 250 now, 251. That same day, I closed out my 175 call for a penny, which expired in a week. I opened a new call, expired about a month later, a little over a month, and I got 41 cents. Because I The call price, the strike was at 135 and Meta was currently at 112. So cost basis didn't go down much. Alright, so then a month later, December 15th, one day before this call expired, I closed it out for a penny because Meta was at 116, well below the strike. And I opened a new call at 150 and got a little over $2. So I got my cost basis down to 248 now. Now I rolled this out to February, so this is a 2-month DTE. So then about 40 days later, January 26th, Meta was all the way up to 147. My strike was at 150, and there was still about 20 days left, so I decided to roll way up and out. I rolled all the way out to January of 2024, but that let me take my strike all the way up to 200, and I collected a little more than $2 credit. And took my cost basis down to 245. I did not expect Meta to keep going up. But wouldn't you know it. And then here's where I'm at now. Meta continued to go up. Matter of fact, it just blew right through that 200 strike by March. I didn't want it to get called away that far below my cost basis. So I took a deep breath and I rolled it all the way out to December of 2025. That let me take the strike all the way up to 280. You see these option prices here are getting pretty significant. I did get a $2 credit for doing that. But at that point, the option was worth $7,600. So not counting that, my cost basis was 244-ish. But I've got a long time to wait. Now, if I add the present day value of that option, which has gone up to 10,500, my cost basis to close out today would be 296. But I'm not going to do that. I'm going to hold on to that option until I can either roll down and in, or until the delta approaches 1 and loses all of its time value. I'll discuss this in more detail in a minute. Meta is currently 240, which is $3 or $4 below what my cost basis is, not including the current option. So now what? Here's how it could play out. Scenario 1. Meta just kind of hovers around the current price for the next couple of years. At some point in late 2025, I'll be able to roll again, assuming I still like it. Scenario 2. Meta takes another big fall. I'll have the opportunity to roll down and in, lower the strike price, and bring the expiration not so far in the future. And scenario 3. It's a little complicated, so bear with me here. Meta continues to climb way beyond my 280 strike price over the next 2.6 years. Depending on when it crosses over the strike, I may be able to roll up and out again. Maybe capture some more underlying appreciation and premium. Or if it zooms past the strike quickly, I'll have to wait until the delta gets sufficiently high, so practically all the time value's gone. Then I can close the option and sell the shares of Meta for whatever the market price is. This will result in me making about $36, $35 a share. Example. Let's say Meta is 600 on January 2025, and the delta is 0.98. The option intrinsic value at that point will be 600 minus 280, or $320. There'll be very little time value left at this point. Let's say $1. So I close two options for $33,000 each. Cost me $66,000 to do that. Then I sell my 200 shares for $600, which works out to $120,000. So there's $54,000 left over. And my cost basis would be $48,738. So I would have made a profit of $5,262. Not a great annualized yield, similar to like a 3-year treasury note probably. But I'm not going to take a deep dive on that right now. I should probably do another video on that. But anyway, none of these scenarios seem terrible to me. The worst outcome would be Meta taking another big fall. If that happens and I still like it, I'll probably also sell more puts to lower the cost basis. Meta seems to have righted the ship. They have 3 billion users to monetize going forward on Facebook, Instagram, and WhatsApp. They seem to have a handle on the metaverse and maybe not spending so much on it. They're in great position to use AI effectively, and maybe the metaverse will pay off someday. I'm still waiting for those awesome augmented reality glasses. Let me know what you think. If you have any questions, if you think I made huge mistakes or genius moves, like and subscribe if you find this interesting.